All right, so we're continuing on talking earnings per share, specifically diluted earnings per share. This is part 5. Hopefully we're done after this one. So here's our situation. It's the same thing we've been following from the 4th one there. But now we're saying we've got preferred stock, non-convertible. So we've got that piece. That's not dilutive because that's just for the preferred piece. It's telling me the average price of the common shares is $25 per share. That is going to come in to be relevant. And here we go. Here's the fun stuff. Incentive stock options. All right. We actually didn't even talk about incentive stock options. I guess this book doesn't get into it. The accounting for it is the same as everything else. It's basically like a restrictive stock option. But anyway, we're not here to talk about that. All right. So executive stock options granted in 2016, exercisable after 2020 for 15 million common shares, an exercise price of $20 per share. The idea being here is that is a potentially dilutive event, right? Because people can exercise their stock options, which then increases the denominator because there's more stock out there in the world. That is going to change our earnings per share calculation. So here we go. Okay. Basic earnings per share is what we covered before. Net income minus preferred dividends, and this is everything we covered in the last piece. It gives you $2 per share. But now we have the what if. The what if is the diluted piece. Oh wow, things are still continuing to happen. Let me move myself down a little bit here. Give you a little bit more screen. There, I think that's better. Okay, so you have the same piece here. Now let's explain what just happened here. The idea was there is potentially 15 million more shares of stock. So if we went back here, there you go, 15 million more shares of stock if they were exercised. Okay, and here's where it gets really odd. It's like, okay, there could be another 15 million out there in the world, and we consider them having been out there for the whole year, right? Which is why we don't do that prorating piece for periods of months. 15 million shares of stock out there in the world. So if people exercise 15 million shares of stock, in theory, they would then have to pay to us for 15 million shares of stock. So if that was the case, we would get 300 million, I believe it is, right? Yeah. Because, all right, ready? We'll go back for a second. 15 million shares of stock, their exercise price is $20 per share. So if they exercise all of those stock options, we as the company are going to get $300 million additional funds, right? Capital. What are we going to do with that 300 million? What the presumption is, and this is required to do it this way, because they want all firms to be reporting diluted earnings per share the same way. The company is going to get $300 million. It is presumed, and this is the weird piece, it is presumed that we are going to go back out there in the marketplace, take that $300 million that we got from the stock options being exercised, and repurchase treasury stock, repurchase our own stock. Weird, right? Now, it's not like they're necessarily going to do that with the $300 million, but they needed it to be that everybody did the same thing, so that diluted earnings per share was following the same rules. So the presumption is we're taking that $300 million and we're going to go out into the world and buy the shares of stock. The shares of stock are $25 per share. So if we take the $300 million we get here, divided by $25 a share, that comes out to 12 million shares. Okay, so 300 million divided by the $25 here, we're going to go out into the world, that's the presumption, and buy 12 million shares of stock. So 15 million are going to be exercised, but then we're going to take that cash that we get from the 15 million and go out into the world and buy 12. So we're going to pull 12 back in as treasury stock. Probably not what's going to happen, but like I said, they need to make the rules all play the same way. So really there would be an extra 3 million shares of stock out there in the world, potentially, which would reduce earnings per share to $1.92. Really, really weird stuff, I know. Okay. Okay, I'll let you guys do that one on your own. Convertible securities. All right, so what if there was convertible securities that could be turned into common stock, right? That is potentially dilutive. So if it's potentially dilutive, we have to include it in the calculation. All right, so we're pretending they're converted into common stock. All right, what's going to happen? Well, what's going to happen is we'll have additional common shares in the denominator, right? Because that's the whole point. It's a dilutive event. However, the numerator is then increased. Let's say if it was a bond. Let's say if bonds were convertible into common stock. If that's the case, and everybody converted their bonds into common stock, the denominator is going to increase because there's going to be more shares of common stock. But what won't you have anymore? You won't have bond interest to pay out. So if you don't have bond interest to pay out, that's actually going to increase our numerator because we'll have more income, right? Because we won't have that interest expense lowering net income. So we have to add back bond interest. And there's one more piece to that, but we'll get to it when there's an example. Or if it's preferred dividends that turn around and are converted into common stock, then you don't have to pay out preferred dividends anymore. So that numerator piece with the net income minus preferred dividends, that's going to go away, right? So it's all like it all builds on itself. I know, I told you it was getting fun. All right, same example. All the same information. Okay, but now we've also, in addition to those stock options, we also have convertible bonds. 8%, 300 million face amount, convertible into 12 million common shares. So we have a potential for 12 million more common shares to be out there. But what we don't have to pay is we no longer have to pay interest. 8% of $300 million. All right, ready for this. So here's the regular basic, right? We didn't do anything there. But this is what we had so far in our diluted earnings per share from what we had before, but now let's add the new stuff. The 12 additional, that's going to come from converting the bonds. And that's where it gets interesting, even more interesting. Okay, 8% of the $300 million, that's the interest that I said we no longer had to pay out, right? Bond interest. So really that's a plus, right? We'll have more net income, more money. But now we'll have to pay taxes. We're going to have to pay taxes because we'll have more income. So that extra $24 million just bumped up our income. So I want to say it says we're at a 25% tax rate. So the idea is we would have to then calculate what the tax on that would be. So you're going to subtract the after-tax savings. So the idea is that you're not going to come forward with 24 million additional net income. It's 24 million minus whatever taxes I have to pay on the 24 million. I know, it gets really... All right, so now we're at $1.87 per share. Okay. Again, you guys can do this on your own. All right, convertible preferred stock. Last one, I think. What if we then convert preferred stock, right? Then we wouldn't have preferred dividends in the numerator. Okay, so we got all the same crazy information, but we have one more piece. That preferred stock is now convertible into 3 million common shares of stock. Okay, so now we would no longer have to, so now this dividend, if we did this, that's not going to be paid out anymore, and we will have more common shares. So we're going to, that minus $4, that's going to go away. Heck, it's not making it go away. There we go, it's going to go away. We're going to have the 3 million extra shares of common stock, and we have that same calculation about the interest piece for the bond. Okay, so we would reduce, get rid of that. You know, look at this. This is craziness, right? But that's how we actually calculate what diluted earnings per share would be. If we have all these vehicles, we are required to do it. Okay? All right, once you do this, boop, boop, do it on your end. Let's do the last piece, which is antidilutive securities. The idea is, what if there were things that would bring up the share price, the earnings per share, and the diluted earnings per share? So basically reversing the situation. If that were the case, and earnings per share were to increase based on an antidilutive security, okay, so if there's a conversion that would then increase the basic and diluted earnings per share, we're going to ignore it. You would think that we would still calculate it, but the idea is we're trying to be conservative, right? The whole reason that we have to even calculate the diluted earnings per share is because we're being conservative. We're saying all the what if possible scenarios. Well, if it's to our benefit, then we don't actually say it, right? That's we don't, like the same way we don't recognize gains, but we recognize losses if they're probable. Same idea here. Being conservative, not recording them at all. All right, so that's pretty much where we're going to stop with this. Yay, right? That's pretty much where we're going to stop, because now we start getting into more antidilutive items, which I don't see the point in. I mean, you know they exist, but other than, you know, you'd think treasury stock is antidilutive, and it is to some degree. You repurchase your own shares, but it's not, that one's kind of like almost the only one allowed. But if you had, let's say you could buy back shares of stock if it hit a certain price, that would then reduce your common shares outstanding, and then that would increase your earnings per share. We're going to ignore those. We're not going to calculate them. So, we can calculate them, but we're not going to present them anywhere. So at the end of the day, we're just going to let it be. We're not going to worry about that. And I think the rest of this chapter talks about additional earnings per share issues. And they're really pretty obscure. I looked through them and I don't feel like there's any that we really need to be figuring out. Rather, any that we need to be covering in any way. Maybe contingent. No, we kind of talked about contingencies. Okay, so that's it. That's the end of this chapter. That's the end of what we're covering in here. Don't you worry. I'm not going to test you on anything else because the rest of this chapter gets like I said, really obscure. I did talk about financial statement presentation in the sense of that you have to present basic and diluted earnings per share. That's kind of like the very, very, very last piece of this chapter. You know, you want to have multiple years, at least 2, because you want comparative income statements and comparative numbers. And somewhere you would also have to have a reconciliation of basic earnings per share to diluted earnings per share. You know what? That's what I will do. I will go to that slide so you can just see that real quick. I know, cruising past these additional things. This stuff is all like appendix types of items. I have no idea where we are. Okay. Not sure what slide I'm on. Oh, here we go. Financial. Okay, so literally the last thing I want to show you is here. The idea is that you would have some sort of reconciliation so people would know how you got from regular earnings per share to diluted earnings per share. What components are in there. Nobody's going to look at that giant calculation we had in there. They're going to be looking for something like this. Okay, and that is it. Have a great day, everybody.